Good afternoon, everybody, and welcome to the latest Service Department News webinar. Today, we will be discussing the reinvention of the landlord-operator relationship. My name's George Sell. I'm Editor-in-Chief at International Hospitality Media. We are a publisher of online B2B news websites for the hospitality sector, as well as an events and an awards organizer. Today's session is going to last an hour. We're going to have around a 45-minute panel discussion, and then we'll have time for 10 or 15 minutes of Q&A at the end. We'd like to make the session as interactive as possible, so if you do have any questions, please submit them using the chat or the Q&A functions in Zoom. A recording will be made available to everybody who is registered and sent via email in a couple of days. So we've got a fantastic panel to discuss the subject today, and I'm going to ask them all to introduce themselves in turn. We'll go from left to right as we see them on the screen. So Alex, if you would like to go first, welcome to you.
Hi, I'm Alex van Pelt. I look after development across the UK and Ireland for Adagio Aparthotels. So we are the largest aparthotel operator in Europe with over 100 properties and over 11,000 rooms, and looking to grow pretty aggressively and double our portfolio by 2023.
Thanks, Alex. Lionel, good afternoon to you.
Good afternoon, and thank you for having me on today. Lionel Benjamin, co-founder of Adagio Hotels. We launched a hybrid lease model last year. We have currently 10 hotels within our portfolio. We're taking on 5 more, amongst them an Aparthotel in Bracknell of 120 rooms. Our model was created to give landlords a base income lease and a top up from the profit of the business, and looking to develop the business further and hopefully grow from the 15 hotels that we'll be on by mid-August to at least double that in the next 3 to 4 years.
Thanks, Lionel. Will, welcome to you.
Good afternoon. My name is Will Kirkpatrick. I'm head of hotels and extended stay at Gerald. We are hotel valuers and property advisors. We are Europe's largest independent hotel advisory team.
Thanks, Will. And Max, hello to you. Max, are you there? I think you might be muted. We'll come back to Max. Andrew, good afternoon to you.
Good afternoon, George. My name is Andrew Fowler. I'm co-founder of Lock Hotels, Group Acquisition Director of Edyn, and also co-founder of Birch, or also known as Birch Community.
Thanks, Andrew. Max, are you with us? Okay, I'm sure Max will be back shortly. You can see the LinkedIn profiles for our panelists in the chat. If you'd like to connect with them and continue the conversation after the session, then I'd encourage you to do so. But let's kick off by getting, this is a very complicated and nuanced subject, but let's kick off by having a snapshot of the main effects of the pandemic on the landlord-operator dynamic in this sector. So let's maybe start with the operators. Andrew, do you want to start with that one?
Yeah, I mean, obviously there's been some slight differences that have become evident from the pandemic. Obviously, you know, we're an extended stay concept apart hotels, so slightly luckier in that, you know, we could pretty much keep all our hotels open and pivot towards a residential model, which enabled us to, you might say, we bled a bit, or we have been bleeding, but you know, we haven't hemorrhaged, you might say. We've managed to keep our GoPAR positive, which has been kind of a key metric for us, and able to kind of stay alive, you might say, during this pandemic. So it's been challenging, but for us in the future, it's probably going to be a good thing for us because it's highlighted the versatility of our model. And we hope to see some yield compression on apart hotels versus hotels. So we don't know how long this is going to last. This is probably the new norm, or that's the way we're viewing it. But all things considered, we're probably considering quite fortunate at the moment.
Thanks, Andrew. And Alex, does that mirror your experience?
Yes, I think so. I mean, look, we're fortunate to be in the apart hotel space. The apart hotels have been extremely resilient to this pandemic. We've also managed to keep most of our properties open. Obviously, the ones in the cities, like Paris, we've got over 40 properties in Paris across our two brands, Adagio, our mid-scale brand, and Access, our economy brand. And as you know, the main cities have been really impacted by this. So we didn't keep all of those open, but as the business is coming back, we reopened. So we've definitely seen an increase in a different customer base and a new appeal for apart hotels. I mean, obviously, you're talking about the landlord operator dynamic. There are, in some instances, across all tenants, discussions have occurred, and there's been strained discussions, and some tenants have been very well publicized in their discussions. And I think, historically, there's been no contact really between a landlord and a tenant. Really, they're pretty separate. There's not much interaction. So I think this pandemic has actually created an opportunity and a new way of landlords and tenants actually talking together and having a bit more of a transparent relationship, which I think will probably continue and will be of benefit. And then, if you look to the negotiations that some parties have had, it's really depended on the countries. So, the market practice has differed from country to country. In the UK, it's very stringent and tough, whereas on the continent, there's a lot more flexibility for tenants and more consideration of the economic environment. Another factor is the differing laws that various governments across Europe have introduced. So how that's protected lessees, and also I think types of landlords, from private individuals to institutions, etc. If they understand the sector and know that recovery can take time, it's easier to have that conversation. So at the end of the day, that the interests of landlord and tenant are aligned, and landlords want to have tenants in their properties. So the apart hotel space is an extremely strong one and has proven to be very resilient in this crisis. So I think that's been a major plus.
Thanks, Alex. Will, have the landlords that you represent been more communicative with their tenants than usual over this period? Has that been the main impact? Opening up communication channels which perhaps weren't so good before?
Yeah, I mean, there's been a huge polarization between landlords and tenants and so on. One end of the extreme we have seen where it's been very collaborative. As Alex rightly says, landlords and tenants have been sitting down talking to each other for the first time in many years and actually looking at the lease structures and seeing, what they've got today, is that the best lease structure, through to the other end of the polarization where we've had, some landlords completely blind to the tenant and some tenants paying but not paying. So for example, a charity that we're advising, a tenant refused to pay but could pay, and the charity had to go and make a lot of staff redundant. So you have two extremes where it is very, very tricky. But I think on the whole, we've advised on roughly about 20 renegotiations of lease and rent deferrals and so on. And out of all of those, we've just one left. And I think most of those have been very positive. And we have said from day one that this is an opportunity to be collaborative together, to work together and to understand each other's requirements. We have found that, it's been a horrendously difficult past 2 years, but actually I think something good has come out of it.
Thanks, Will. Let's move on and talk about some of the specific ways that collaboration has come about. Max, good to see you're back with us. Do you want to talk about some of the things that you've seen during negotiations between landlords and tenants, and give us a quick 30-second introduction as well, because you missed it earlier.
Can you hear me now?
Speak up a bit.
A little bit.
No, can't hear you.
It's not often you can't hear Max.
It's strange because your sound was perfect earlier, but I can't now.
I'll dial back in.
Oh, there you are.
That's it.
You're here.
Okay.
Yeah, go for it.
Very strange. Sorry about that technology for you. Or it's probably me actually. Max Thorne. I run a company called the MRP Group. Our main drive is to we run feasibility reports on the market. We consult to operators, owners, and banks, and we run transactions for operator search and land sales. So I think the 1st of April last year, about 75% of our business went on hold in our consulting arena, which was to be expected. And then post-April, we decided to offer a kind of pro bono service out to the operators. And that was probably more at the smaller end of the operators versus the likes of Seiko and Lock, etc. We were very busy last year. I'd say the first 3 or 4 months, we almost had no traction in being able to resolve problems. Once we came back from the summer, about 75% of the owners that we talked to, once, interesting Alex, we had put them in contact in a 3-way forum with ourselves and the tenant, we managed to start to get traction. And there was a whole variety of propositions that we managed to get agreed. There was some rent freeze, there was percentage of rent to turnover, there was catch-up mechanisms, there was profit shares on management basis. So post-summer last year, we saw a good percentage of the landlord market being willing to be flexible in their views. I do think, however, that was primarily forced, but there was nothing. So there was a possible legal pursuit, there was handing back of keys, and the horizon at that point didn't look particularly good. So it was forced, I think, in most cases, but nevertheless, you know, all credit to both tenants and landlords. Most have found a way through. A few, unfortunately, haven't. And we know who those are. But yeah, we've been super busy. I think we're set for next year, and I'm talking about next year because I think we've got a fairly busy summer, but I think we've probably got some issues to deal with in the last quarter of this year. So I think as Andrew mentioned earlier, that this is going to be with us for some time, and that's how we're planning to run our business. And however, I do think 2022 is probably going to see more traction. And again, I think there's been some precedent set on new models, and I think landlords are willing to talk to tenants, and tenants are willing to talk to landlords, and that 3-way communication or 2-way communication is driving, I think, more results than we would have got if we hadn't have done that.
And have you seen the lease structure on some of the deals that you've been working on that are in the pipeline? Has that been amended as this pandemic has worked through? Yeah,
listen, there's lots of fantastic and crazy ideas around get out clauses and pandemic clauses and COVID clauses. And I think the principle is that is everyone willing to have a fair discussion around how we deal with this going forward? Because we don't know whether it's going to finish next year or in 2 years or in 5 years. And I'd probably argue we'll see variants popping up over the next 2 to 3 years that we may have to adjust the way we work and live for short periods of time. The general principle of is everyone willing to approach a negotiation with that in mind and being fair is yes. Actually making new ground and setting new precedents and attaching that to something which a KPI that can be fixed, and whether it's RPI, CPI, STR, or some other data house or a group of hotels is on paper very simple. In practice, it's quite complicated because you'd never know who's going to be still here in 5-10 years time. So, but there is a willingness. It takes some time, but we have been successful, and as I've heard, other operators have as well.
Thanks, Max. Okay, well, let's talk about some specific structures that have been brought in some cases before the pandemic, but have come into play in this period. Lionel, do you want to kick off by telling us a little bit about your model and how it works and the advantages of it in a situation like the one we find ourselves in?
Thank you, George. Yeah, we launched the model last December, and the model was to try and bring landlord, tenant, and brand to the table with a totally aligned view, and to create transparency for the landlord primarily. Our belief is that if the landlord felt that his tenant was strong and was able to pay, then the landlord is more likely to come along to us as the tenant if we could demonstrate that ability. So we focused the model by not being overly aggressive on the rent, and then different to many of the lease structures that we've seen historically that are linked to a turnover top up, we are giving our landlords a turnover, an EBITDA top up instead. So we've had to have a lot of dialogue with the landlords to take on board the operational risk. And the reason that we were able to secure the landlords so far is because the valuers have looked at the rent at the levels we've set them at, which pretty much need to be achieved circa 30% occupancy to pay the landlord the rent, whereas other models have got to pay rent based on probably 65 to 70% occupancy in the hotels. So though it's a lower rent, it's far more achievable, and therefore the yields that have been given to the hotels that have been valued, that have come across to us so far, have achieved a yield at around 4.25% to 4.5% on the base rent. The turnover, the EBITDA top up, I'm so used to saying turnover rent, the EBITDA rent is valued at 7.5% yield. So the blended that the landlord gets is circa 6%. And the biggest advantage is that because of the transparency, we say to the landlords that we're putting in capex to your property because we're taking a 25-year full repair and insuring lease. We're linking it to CPI. And in order to ensure that your profit is going to be protected and grown, we insist on having an amount of capex below EBITDA, and then NOI, and then rent gets paid first, and guarantee the rent to the landlord. Now, the capex pot is 4% of revenue for the first 3 years, moving up to 4.5%. And we show the landlords, again, this transparent approach, we show the landlords exactly where we're spending their money, how it's going to improve their asset. And again, when the valuers and the banks have looked at it, I think it gives them a surety that the asset's going to be protected. So when banks are lending on it and they're looking at the model, they've been supportive of their borrowers, of the landlords, to allow them to move across to our model. The good news is that in March, we had a rent-free period for the first 3 months. So between December the 18th and March the 17th, we'd anticipated opening the hotels on the 11th of Jan. Obviously, for a number of reasons that are known to everyone, that didn't materialize till 17th of May in most cases, but in some cases we couldn't open until later on in June because there just wasn't consumer demand. Nevertheless, at the end of our rent-free period, we paid the Q2 rent in March, and thankfully we've paid Q3 rent as well in June. So our landlords are receiving their minimum rent guarantee, and it's created very good dialogue because the landlords who we're now talking to are saying, you know, how's it all going? We're being very transparent. Unlike what they've had previously, they get sight of a P&L, they get sight of the profit that we're making in their business because it is their business. They're a partner together with us in that business today. So that's really the bones of the model. And on the back of the 10 hotels, we've got another 5 that are currently in legals, advanced legals. And I expect that we'll be taking those hotels over between middle of August to the end of August. So come September, 15 properties. And we're looking to try and grow the model. The only way we're going to be able to grow the model is by landlords believing that actually they can achieve added value by taking on a lower initial rent so that their worst case is always provided for. But in the best case scenario, when business returns, they will suddenly start getting a lion's share of profitability in their bank accounts, which they wouldn't have previously enjoyed. So they know the downside is covered by the rent, and the upside is however well we're able to trade, which is why they're also willing to reinvest in their properties through the capex that we're holding for them. And in short, I guess, George, that's the model.
And you mentioned that one of your 10 hotels is an apart hotel or a service department development. Are you seeing much interest from owners of properties in that space?
I think we're beginning to see that owners are understanding the model, and it's down to us to get the PR out there and make sure that landlords and the banks and the valuers that are working on the real estate side, because unfortunately they're not all like Will, who understand our industry. Many of our clients are real estate investors, and the banks are asking the real estate valuers rather than the hotel valuers to get involved. So it's really an education process, George, for us to share what we're doing with people and emphasizing our partnership with Accor, so that they know that our standby rent facility that we have with Accor is something that gives a lot of comfort to the landlord, the valuer, and the bank. So it's really creating awareness around it to get more of the apart hotel landlords into our model.
Thanks, Lionel. Andrew, let's move over to you and have a look at your slide of your model, because it's also another interesting take on it.
Sure, I'll take you through that as one of the sort of the mechanisms we've used in the past. Just to sort of contextualize this, we're probably 2/3 asset heavy, 1/3 asset light. So where we're typically signing leases is in locations where, they got lower cost of capital, chasing assets that's very hard to develop in. So typically more central key location cities. So probably less risk, and I'd love to hear, Alex's and Lionel's view on this, because obviously they probably do some more peripheral locations. But so we actually like, a fixed lease, and we'll still like to do a fixed lease as opposed to a hybrid lease going forward, because we have a very good, handle on our kind of risk reward profile or our operational models. So if we're going to go into a key location such as a Paris, we know what the metrics are going to do over a long time. We want the fixed lease because we want the upside as opposed to splitting the risk, which would be different on some of the more regional assets that we will do with the Cove model going forward. And, to give a view for a landlord's perspective, who are probably watching this as well, traditionally it was all about covenant. It was about covenant and it was about rent. And what we saw through this downturn was even the institutional grade tenants, were not paying rent, or were not unable to pay rent. So I think going forward, there's a massive re-education going to come through, which will be led by the likes of Willis and his team, when we start to see the revaluation of a lot of these leases post or in the new world, we might say. So it'll be rent cover ratio will be a massive factor. I think they need to look at. The rent cover ratio has got far too tight, sub 1.3 in Europe. That was crazy in our view. And I think really the business model going forward, the versatility of the business model, look at how they pivoted, or how did that hotel operator, pivot in the downturn, because that's going to give you insight into their ability to deal with, Armageddons or serious situations in the future. And also, where are they going with their, I know we'll probably touch a bit on, the franchise, where will the franchise go, but the technologies they're developing through their booking systems, revenue systems, and marketing systems, because that is where the massive change is going to take place over the next 2, 3, 4 years to compete alongside the brands and the brand booking system. So that I would really, really look at that sort of operational model as well, and how they've performed over the last sort of 2 months. Having said that, obviously some kind of variable system that doesn't kill the tenant and protects the landlord. We've managed to utilize one as such so far, and I'll just sort of drop it up on screen. Hopefully it picks up my desktop and not something else that I shouldn't have been watching. Can you see this, guys?
Yeah, that's good.
So here what we have is the blue line is effectively the hotel revenue or the hotel RevPAR. The line below that with the steady increase is CPI. On the basis of this is where you had a considerable drop. This was actually manufactured out of, Lehman crash scenario where we saw, 25, 30% dips. It certainly wasn't like the sort of the 60, 70% dips we've seen this time, but the basis was where you had a dip of below 30%. So we would have a pre-agreed set of hotels. That could be all the upscale or upper upscale hotels within the central zone. We used STR, but something else could be used. And where effectively that index dropped by more than 30%, there was a percentage rent adjustment for us. And this is implemented for us in one of our locations with an institutional landlord. And as the RevPAR is obviously coming back now an awful lot stronger than CPI, as soon as we go back above the original CPI, let's just say here it's in year 2, there'll be a cash sweep to the landlord for the clawback. Now, the question is if I move on to slide 2, what happens if it doesn't catch up? So what we do know is, or what we certainly feel is that we are now in a new world. There's a lot of people out there, maybe landlords, saying, right, let's wait till things come back to normal at the end of 2021. You're in for a rude awakening because it's not happening. We're in this for the next 4 years, possibly for the foreseeable future. Travel, certainly business travel dynamics have changed forever. We don't know what they'll end up being, but we could have a situation like this where the hotel RevPAR takes 10, 12 years to catch back up where it would have been if the 2019 numbers had carried on. And in this situation, we have a 10-year clause where if it hasn't caught up by then at that stage, the landlord would be able to invoke that clause and would pull us back up, as you can see here in year 10, it pulls us back up to the CPI line. And obviously there would be a clawback in the future when it went above that. So the challenges with this is you're using a non-institutional grade index. So an STR set is not institutional grade. And for something like this to work mainstream in the future, we would need some form of hospitality index.
Thanks, Andrew. You're obviously in an unusual position in that a good proportion of your inventory is owned by Brookfield, which also owns the operating company. And I think you said you've got this particular model in one lease. So what has been the reaction to it from landlords of some of the other properties you operate? How has it been trying to convince them to adopt this?
Yeah, as I said, we've only done it with one. We've probably got 6 or 7 key leases. We've only managed to implement it once. As I said, the biggest roadblock to that has been it's a non-institutional grade index. But we do have profit share leases. So we have one lease where we've got a fixed element, and then we would have an EBITDA split directly above that. And we also do have one management agreement, although we try to avoid management agreements like the plague because we can't control. So the brand curation of the asset becomes a little bit of a gray area. You have to have a very, very close relationship. So the only one we have is with Apros in Dalston, which is actually an MA. But apart from that, we're all leases.
Okay, thanks, Andrew. We'll move on to management agreements in a minute. Will, if you were representing your landlords, what would be your initial reaction to the two models that Lionel and Andrew have put forward?
Yeah, I mean, Andrew's had the misfortune of having to talk to me, so we know each other very well. I think just for contextualization, I mean, I see also many different types of landlords. So let's say if we take pension funds. So pension funds require fixed income. The reason why they're paying super keen yield is that guaranteed income. And as Andrew made a very, very strong point is, and it's one of my frustrations, is that when some of these rents have been set, they've been set at too high levels. So during COVID, we had to do a review of a pension fund portfolio, And I kid you not, one of the rents on a regional asset was sitting at 70% of NOI, which is just completely unsustainable. So, one thing I hope that we've learned from this process is that, we shouldn't be looking at setting up rents by comparables. They should be looked at doing a detailed profit review of the asset and the location and so on to make sure that those rents are sustainable for that property. And I think that's one key point. And actually, if the rent is slightly lower, actually the yield comes down because it's more secure. So actually, paying rents at the top end of the range is not always the wisest thing. So, we go back to the very basics of, rents for regional assets, somewhere between 50 to 60% of NOI. So NOI being EBITDA after FF&E allowance. If it's a strong location, then going up to 65%, and then very, very exceptional, and I mean very exceptional, going up to 70%. And 70%, I would say, is prime central London, where you want to get that asset. If people follow those sort of rules, I think then the pension funds, and at the end of the day, if we look at the growth that's come out of both the apart hotel and hotel sector, is the pension funds have been basically investing most into these sectors by developing that pipeline. So there's horses for courses on that. So if you leave pension funds to one side, the other end of the spectrum, you've got independent owners, and then also you've put property companies in the middle. Independent owners, what Lionel's doing is fantastic. They can actually get a better return for that. They're more flexible. They've got more options available. Their debt levels are at lower levels, and so they've got more options. So I think there's a balance there to be had. But I think the key thing is getting the rent set at the right level. If you're trying to develop your portfolio, trying to create a product that a pension fund can get behind, then it will help you grow your asset and your portfolio. And it is just getting that balance right.
Thank you. Andrew, you've raised your hand there.
Yeah, it's a question for Will, and not to put you on the spot, Will. But where, if we took a like-for-like situation, which we don't have, let's just say something in Zone 1 London, because it's one we can all relate to quite well, and we look at, the rent cover ratio or the percentage of EBITDA as the rent, ranging from 50, which is a 2 times rent cover, up to 70%, which is nearly sort of 1.4. If you were valuing 2 identical assets going forward, one is at a 50% cover, one is at a 70% cover, what do you think the difference would be on a yield? Let's say assuming a lease. Where do you think that arbitrage will go in the future?
I mean, I'm not going to answer the question you want me to say, but I will answer it. I'll give an example. So the Travelodge at Euston Station was bought off a yield of 3.23% yield by LaSalle. The reason why LaSalle paid that yield was not because of Travelodge, not because of the covenant. It was paid because the VP value was actually higher than investment value. I know that goes against everything we were taught at school, but because of central London, the security of the income and the keenness of freehold yields in terms of hoteliers trying to get into central London was creating that. In terms of, to answer your question, I mean, if you look at Z Hotels, what Z done quite cleverly, and I apologize for going off into the hotel world rather than the apart hotel world, is a lot of their assets, they had lower rents. So what happened was, while Z Hotels didn't have any covenant strength or didn't have an institutional grade covenant strength, CBRE Global Investors and various others invested into their assets at keen yields because the rent levels were very low. So you're right, Andrew, in terms of central London, at the end of the day, the VP value generally tends to be higher. So you don't necessarily need to pay these very, very high rents if you look at a holistic review. The only thing I would say to you in terms of pension funds is prior to COVID, we were working with a number of pension funds, and I'm sure Max was as well, looking at technical management agreements. And as you know, Gerald, we advised L&G on the acquisition of the hotel under a management agreement. I do think actually, to be controversial, in central London, pension funds, why have a lease in central London when the income's so secure? Why not go for a management agreement? And I do think that pension funds will do more of that. And I think it comes back to this: where is the right place to lease? Where is the right place to have a management agreement? But I do struggle, although we act for a number of London estates, and they don't want to get involved in operational businesses, and the same with pension funds and so on. So there'll always be a demand and home for leases. But yes, sorry, Max.
Appreciate it. Thanks.
Thanks, Will.
I just wanted to come back on percentages and rent coverage. I I think the model works really well for central London and for the regions, and I think there's a band that most properties sit in. I'm always cautious of percentages because they're percentages of something. And I raised that a couple of years ago. I was asked to review what I would call, don't take this the wrong way, Andrew, probably London's premier 5-star operator. And the question was, the GOP percentage was extraordinarily high, and the rent allocation internally was extraordinarily high. And it was just a factor of the RevPAR was extraordinarily high. So what I mean by that is you've got £100 a night and you've got a GOP of 60%. When you go to £200 a night, that GOP doesn't stay at 60%, it comes down. Sorry, it goes up. So I am cautious around percentages, but I do generally think the tone here of 1.6, 1.7, even 1.5, I think today rent coverage is too high. I think it needs to be sub 1.5, and 1.3, 1.2 is where I'd like to see it. But landlords are greedy and tenants are competitive. So we end up in this situation where people are forced, if they want to get stock, because they haven't got the covenant or they haven't got the coverage to push those numbers. So there isn't a right answer, but apart from trying to be safe.
Max, I mean, Max, you say that, but no one. We've done an operator selection process recently, and I was acting on behalf of the pension fund, and we actually went back to one party and said to them, "Your rental bid's too high. Can you please go away and have a look at it again?" Landlords don't want tenants to be having rent that they can't afford to pay, because at the end of the day, especially pension funds, all they want is income, and they don't want any risk. And I think some put landlords down as the evil, and I'm not. And I come from, also I spent my career working with the Premier Inn, so I've seen both sides of the coin. So it's got to be fair. But I have sat down with tenants and said, look, your rental bid's too high. That's not sustainable. You need to come back and have a look at it again. And that's happened on more than one occasion.
Yeah, I don't disagree with you. Listen, I wasn't suggesting landlords are the evil here, but I think 75% of landlords are looking to increase their income as much as possible. But
I think, Max, we can do that through value, though, can't we? We can do that through giving them added value. And I think this is where if we give lower rents and we can get those valued at sharper yields, and then the top up profitability or the top up rent, wherever it comes from, is that more of a franchise model, and yet you've still got that blend that gets you over the line. You're adding value from day one that someone can go and leverage, and they want finance, don't they? They want to be able to finance their properties. They want to make sure their tenants paying enough rent to cover the cost of their debt and leave them with some profit, and they're looking at the equity growing in terms of longer term value.
And I agree with you, Lionel. I just think we need a bit more education, and we need a bit of proof of concept. So thanks to people like you that are driving it, we'll look back in 3 or 4 years and we'll see that actually it has worked. But today, we still need that proof of concept. I know you're on the road there, and we need valuers to take that on board as well.
We need to see the valuations, and we need to see the transactions over the next sort of 12 to 18 months to prove that there is considerable appetite for tighter yields on less risks. And again, to Will's point, you've got to caveat London, because your residual VP values fly in the face of what we're trying to figure out here. So we should probably look to the regions or to other cities to try and extrapolate that.
I think that's why we're staying in provincial UK for now. We haven't yet stepped into central London, and we haven't stepped into major central locations. We're not in the places like Edinburgh and Oxford and Bristol, where we're peripheral, where landlords can see that, I think someone mentioned this earlier, we've got to have the ability to pay our landlords rent. And the landlords appreciate that today, which I don't think they did previously.
So let me put Will back on the spot, because he dodged that question by going to... Let's take the same situation and do it in Birmingham, Will.
Okay.
Same hotels, one's got 50%, one's got 70%. You're asked to value them going forward. Lease yields, what's the spread between the two?
Okay. Yeah, so what I would do, I'd split that into two. So especially for a city like Birmingham, on that there we do a hardcore and top slice. So we apply a more aggressive yield to the 50%. If we believe that it's over rented, so I give that example of that pension fund that we had to advise for, the rent that the tenant was paying from 50% to 70%, let's say, we thought, if in that scenario we thought was actually over rented, and I use that term quite loosely because it's quite a strong word, then we would apply a greater level to that. So yes, we would move out the yield to that top slice. So, and that's a danger with with overpaying, is basically the valuations will never fully reflect that there's extra rent that the tenant's paying, if that makes sense. So basically the tenant's paying, this extra rent between, let's say, between 50 and 70%, but actually the valuers aren't reflecting, because it's more riskier. Because if you had a hotel in central Birmingham and let's say the tenant defaulted at 70%, and bearing in mind the risk of him defaulting at 70% or she is greater, then the chance of you replicating that again is very challenging. Now, I come back to my three owners. If I'm an independent owner or a propco, then I can take more of a view. But then if I'm a pension fund, that I'm not in the hotel business, the Aparthotel business. I'm here to get income, so I don't want that risk profile. So come back to my point about the rent sustainability.
Let's move on a bit. Max, you said something interesting earlier that landlords often don't know if any particular operator is going to be here in 5 or 10 years' time. Now, in the UK, we traditionally have 25-year leases, but Alex and Andrew are both representing pan-European operators. Are we going to see a shortening of average length terms here in lease terms here in the UK? Alex, do you want to pick up on that?
Yeah, hi. So look, I think hopefully we will. I mean, if you compare what happens in the UK, it's 20 to 35 years typically, whereas in Europe it's 10 to 12 years. So there really is a kind of imbalance between what happens in Europe and in the UK. So I think if there's more flexibility in the UK, of course it will be much easier to have more developments. And I think the terms in the UK are pretty punishing for the tenant. If you look at the fixed rent, the RPI, stamp duty, and then the contingent liability on the balance sheet for the entire duration of that rent period, it really impacts operators' balance sheets and the ability to grow. So I think something has to change. And in terms of Adagio, to Andrew's comment regarding more peripheral locations, look, we're growing by lease management and franchise, and from a leasing perspective, we are looking at really prime core locations like London, Edinburgh, Oxford, Cambridge, and Manchester now, where we will lease. And in terms of the variable side, I think, if you're looking at a variable lease, it's great when the market is in a downturn, but when the market is buoyant, it's not so good for the tenant. And looking at the minimum guarantee, there's usually a minimum guarantee associated with these variable rents, which could be 60, 70, 80% of the rent. And then, if there's another pandemic, is a saving of 20% of the rent going to protect you from disappearing? It's not. And I think, to Will's comments, I think you've got to have a well-structured lease, and it's important to determine the correct rent for the market and the right rent cover ratio. And you need to have a good vision for the market performance going forward. I mean, this pandemic has been crazy and no one anticipated it. But I think I'm not sure that, the variable side is with the minimum guarantee is a solution either. So we've obviously, we can't ignore the last 18 months, and we've introduced pandemic clauses, but we're actually still looking at fixed leases. But we're a very sensible model with the biggest hotel operator in Europe, and very, very robust, and our landlords really have trust in us. So I think just to it's important to structure that sensibly.
Would you know roughly what the breakdown is of your European portfolio in terms of how many franchises, how many leases, how many management agreements, and how do you think that ratio is going to change going forward?
Yeah, so at the moment we have 9% franchises, 20% leases, and the balance HMAs. So we are, I think for us, we're definitely looking towards a more franchise-led growth, apart from in specific markets, you know, the ones I mentioned before. So yeah.
Okay, thanks, Alex. Andrew, what's your take on perhaps leases here in the UK taking on a more European model? Would that be advantageous to you, and is it likely to happen?
Yeah, I mean, absolutely. We would never sign a full corporate covenant for 25 years. I think those days are gone. You know, a typical lease in Europe might be 1 year corporate, 1 year bank. You can get slightly better than that. You can get slightly worse. That's a fairly standard across Europe. And I think that's probably where the UK needs to move a little bit towards that. And I think this pandemic will actually help that, because as we said, it's become very evident it's not about covenant, you know, or certainly not just about covenant. We've seen the biggest of the biggest get into trouble and not be able to pay rent. It's the key other items, you know, what is their development of their systems, their technologies, their ability to pivot, how they've performed over the last 4 years. So I think there's a massive number of factors, rent cover ratio, that's going to come into all of this going forward. And it's almost like a suite of toolbox, and you need to go through all of those. But certainly the UK system has to change. I just can't see people signing, you know, 25-year corporate guarantees anymore. Those days are gone in my view, you know.
Mm-hmm.
Will, yeah, do you want to come in on that? You're muted, Will.
You think I'd learned by now. I mean, you said that, Andrew, but I mean, we recently took a development opportunity to central London last week. Not last week, sorry, we got bids in last week. And out of all the offers we got back in, and again for the Aparthotel sector, virtually all of them are 25-year lease terms, if that makes sense. And that's up to date. This is, as I said to you, we got some proposals in last week before that. So, I think also the other point worth mentioning as well is in so places like Germany, where the banks are much more flexible, so the bank terms are much longer. So the landlords have a very different viewpoint, whereas in the UK, you know, funding seems to be more, well, it's more expensive, and it's shorter as well. So the landlords are under more pressure, and not all the landlords, I should say, but some landlords are under more pressure because they have to refinance. So, I mean, it's difficult. I agree with you. Things have to change, and there needs to be more flexibility. It's just how we get there, and that's a challenge.
Yeah, I mean, I completely agree that the long lease is there to stay. And, you know, if I'm signing a lease, I want a long lease because my residual value on my DCF on my lease is going to be far better for a 25-year as opposed to a 15-year, you know, discussion we've only just had sort of recently. So the long lease, I think, is there to stay because there are advantages for both parties on that. It's, you know, the covenants, it can't just be about, you know, 25-year corporate covenant. You know, I think we're going to see, you know, there's a massive opportunity for insurance products, you know, bond products coming out of this. We're talking to some of the people that are in that sector, and that needs to come forward, and that will evolve off the back of this, because as I said, when you've got the biggest of the biggest who aren't paying their rent, well, you know, what does covenant mean? So I think there will just be a lot more factors considered going forward. Yeah, you know, the banks will probably look for between 6 and 10 years, maybe, in terms of if people want to finance, obviously, off the back of a lease, which is a different thing from, you know, putting a tenant in a building. But, you know, I don't think banks need 25 years covenant. You know, 6, maybe 10 should be sufficient to allow funding structures off the back of that. When you consider some of the other things, you know, if they have an insurance product, or you can get an insurance product, you know, we were lucky actually that a couple of our business interruption policies covered some of our buildings because we had worded them correctly. So let's not forget insurance as well in the future, and the importance of that as part of the covenant.
Thanks, Andrew. Max, we've seen very different attitudes towards management agreements from the operators on the panel. Do you see them becoming a bigger part of the mix going forward, or will the sector be still be predominantly lease based in the future?
I think the sector has probably got the biggest opportunity it's ever had to grow up. So what I mean by that, I think for the last couple of decades, it's been growing at an enormous pace. I think the last 18 months has shown the willingness of the customer or preference of the customer to stay in an apart hotel versus a hotel or a service apartment. So I think there's massive traction opportunities, massive growth opportunities. But relatively to the hotel market that is predominantly management agreements, it will still be seen as an underdog in a competitive situation. So if you have a site and you've got really strong grade A hotels coming in on management versus a mid-range apart hotel operator, it's a tough question for an institutional investor where they go. I think with the likes of Brookfield, Capital Land, Mapletree, all making big moves into the service park market, that can only go to support the argument that it should be considered as an alternative. I hope, and no one loves this sector more than me, that we get to a point where we're on an even keel. And if we get to a point where we're on an even keel, to Andrew and to Will's point, why on key locations would any landlord, I mean, I don't know why a landlord would take a lease in central London unless it was over rented, because the upside is and the upside is much greater, and the pricing from a valuation is likely to be it's unlikely to be more than a bit, or it shouldn't be. But we're in strange times of valuation right now, so again, that's really hard to prove. But yes, I think the opportunity's there. I think if this pandemic goes on for another 12, 18 months, and believe me, I want it over as soon as possible. I'm not wishing it any longer. The longer it goes on, I think the stronger the position of apart hotels are, and the more opportunities will come out of, unfortunately, some failed offices and hotels, possibly students. So rapid growth, institutional investors coming in, that we have that, by the way, in a fairly large way right now. It's just not in the public domain. So yeah, I do think management agreements will become part of the apart hotel service apartments future. We just need a few more Andrews and Wills out there supporting it.
You've gone some of the way, Max, to answering a question in the chat from Sarah Buck. She says, is there more resistance from landlords / investors / banks to the service department model versus the apart hotel or hotel model? Do you think this will change given the popularity for travellers to have their own space in individual apartments?
It will change with data. The more data is collected and then published that shows that pound per square foot, in my opinion, apart hotels deliver a higher profit to investors and owners than a traditional hotel. It's not always the case, don't get me wrong, but in central locations, upper 4-star, I don't think hotels challenge what a apart hotel can return. The more data we have, the more we can evidence that, the more we can get traction from the investment market. The more money we get from the investment market, the more transactions will happen. Yeah. I mean, it's quite simple.
Will, do you want to jump in on that? And then Andrew, I can see you've got your hand up too.
I'm going to take probably part of Andrew's thunder. When Seco was in its early days in 2012, so we were valuers for HSBC at that point, which was supporting Seco, and we were with Seco during that point where they transferred from being service departments to apart hotels. My viewpoint at the minute is very, very difficult for them to grow. My viewpoint, I generally don't understand why more investors do not go into the apart hotel sector. There are very few businesses which produce the level of profit conversion that apart hotels do. It's very, very clear. And Andrew, we've worked with Andrew on the landlord side. I'm not a landlord personally, just that I do work both sides, okay? But on 3 of your locks, we have reviewed most of Stay City's portfolio, most of Native's portfolio. I mean, there's very few businesses that provide that level of profit. And actually, the closest business to it in terms of the hospitality sector is the budget sector. And if you look where the budget sector has grown from the early days of Premier in 1987 and Basildon, I do apologise, to where it is today. My viewpoint is we need to work with investors, show them that actually the apart hotel model You know, we don't have the vagaries of the hotel I went to inspect recently with 13 chefs walking out because they had a dispute. We don't have that problem. We can actually work with the local estates. So for example, some of the London estates that I advise on, that actually having an apart hotel is brilliant, because actually it helps their restaurants, it helps the shops and so on in that local community. So there does need to be a big educational piece, and as Andy rightly alluded to, how we value that's quite difficult. We haven't seen enough transactions, but certainly, you know, I'm a huge fan of the sector.
Thanks. Andrew, go ahead, then I'll come to you, Alex.
I think just to add to that, you know, before people go, right, great, pilot service apartments, and to Max's point of, you know, proving the viability of the bricks and mortar of an extended stay concept versus a hotel, the dynamics, or what we're finding is the dynamics are so different, you know, in each city around Europe in terms of what's the optimum size of a unit or the layout of a unit relative to the length of stay, because obviously we can chase transient, get a very high rate, we can go after super long length of stay, get a very low rate, and it's all about finding the sweet spot in those locations. So, you know, it could be 4 or 5 days, it could be 8 or 9 days, depending on the location. And one of the biggest things we're doing is running our own software now, which is telling us in every location that we're in, what is the secret sauce for that location in terms of what sort of an apart hotel we should be. Should it be X number of micro studios, X number of large studios, 1 beds, 2 beds? What is the extended stay sweet spot in that locality? It's not just a case of, right, let's build some apartments and we'll get a better conversion. It's what sort of an apart hotel are you going to build and why? And that's why you'll notice that every lock is completely unique to its destination, because we're using that metric or that data that we're building to move in to the next locality, and obviously just try and stay ahead of the curve, because we know the competition is coming in the sector, and we've got to evolve and kind of stay ahead of that. So to Max's point, it's about proving the viability relative to the demand drivers in that specific location.
Sorry, Andrew, I was temporarily distracted by somebody hanging a giant mirror ball over.
Yeah, you've got a disco later, I think, Andrew. There's a big disco ball going up behind you.
We've got our office launch party tonight. You're all invited in Borough. If you want party lock style, come on down.
Alex, did you want to pick up on that point, and then I'll come to you, Lionel?
Yeah, just very quickly, I mean, just to Will's point, it's the apart hotel extended stay model is just such a profitable model. It's low cost base, it's very resilient with different demand profiles, short, medium, long stay. So, and now with the pandemic, it's even increased in popularity going out to new markets. And I think why did not more people go into it? Well, we're only at the start. It's a very nascent market compared to the US. So I think certainly we're seeing a lot more requests for apart hotels and actual conversions of hotels into apart hotels, or repurposing of other uses into apart hotels. So I think this sector is only going to grow. And, you know, from our perspective, we are the most profitable brand per square meter that Accor has. Accor now has 42 brands, so quite a few. And, you know, in terms of Andrew's comments regarding unit mix, that is really important to have that sensible mix between studios, 1 beds, and we've actually introduced a new co-living concept in our Adagio, our mid-scale brand, and the idea is that we're going to try and capture some of that Airbnb business. We're not necessarily thinking we're going to get a better profit per square meter, but it's tapping into a new market. So the leisure, friends and family staying, or co-workers, where they all can stay in a communal area with rooms off it. So it's yeah, it's a good sector.
Thanks, Alex. Lionel, I think you wanted to come in on Max's point.
Well, yeah, well, one of the more recent issues that some of our potential landlords have been mentioning to us is that they've got hotels that they've been struggling to operate, and the biggest struggle they've had has been labour. The ability to actually recruit those 13 chefs that Will was talking about, and the reason why those chefs can walk out the door is because today there's such a demand for them. Our landlord pipeline are talking to us about converting hotels into Aparthotels and longer stay, because they don't want to have any risk, or they want to reduce their risk as much as they can. They like the idea of a rent, a fixed rent, and they like the idea of, you know, they'll take some risk in operations, but can you limit that risk by me not having to rely on team members that I can't find anymore? And if we can automate, and one of the things that I think is very, very big focus for us is automation. So, you know, towards Andrew's point, ensuring you've got the right mix of flats and where you're putting these apartments and the configuration. Anything that can advance in terms of IT and reduce the operating model even further. The landlords are very in tune with this, and I think the labour market and the failures we've had, over the last couple of months, only emphasised even more in the last 2 weeks by pandemic, is just making landlords rethink as to whether they should repurpose hotels. So I see that as another growth area, and I can see more hotels realising that the benefit of conversion to the Aparthotel service apartment model.
Yeah. Thanks, Lionel. Unfortunately, we've already gone over our allotted hour. It's been a great conversation. There's loads more we could have got through. And just before I wrap up, I want to show a couple of quick slides. We are, pandemic allowing, we are hosting a fantastic new event in October called the Urban Living Festival, which looks at the blurring between various hospitality and real estate disciplines. It's going to be a great event. We have got a fantastic cast of speakers and sponsors, and if you'd like to find out more about this event, then my colleague Katie's details will be in the chat shortly. We're going to take a month off from the SAN webinars for August, but we will be back on September the 9th, and we'll be getting our crystal balls out, looking at how we think the industry will look in 2030. And if you'd like to register for that, the link is in the chat. The pandemic has forced us to take a look at how we do business, and we've been able to pivot quite successfully to the webinar model, which has been a lot of fun and a great learning experience. And we've just got a very quick video to play here, which kind of sums up the things we've been doing.
Hello.
Good afternoon.
Hello.
Good afternoon.
Well, good afternoon. Hello, everybody.
And welcome to the Trailblazer
Service Department News
Rockstars.
Urban Living Live
Engage.
Urban Living webinar series.
I think you have to tell the right story to the right people via the right people is really, really key in the right place.
Because we are all in the same, in the same boat. We want to make this work.
When you take away that personal contact, it's a problem.
Through the concept development, through the architecture, through the design, through the experience.
So although it's a growing sector, there's still huge scope for it to evolve even further.
Okay, as I mentioned earlier, contact Katie if you'd like to get involved in sponsoring either these webinars or the Urban Living Festival. Thanks for watching today. It's been a great session. Thanks ever so much to Alex, to Max, to William, to Andrew, and to Lionel for their contributions. Really great discussion today. Enjoy the rest of your day. We're going to leave the chat open for a couple of minutes because there's a lot of information in there. So if you'd like to catch up on any of that, we'll leave the session open for 3 minutes while that clock counts down. Other than that, thanks very much and enjoy the rest of your days. Thanks a lot. Goodbye.